This is the Rich Dad Radio Show, the good news and bad news about money. Here's Robert Kiyosaki.
Hello. This is Robert Kiyosaki, the Rich Dad Radio Show, and we're broadcasting from beautiful Scottsdale, Arizona, where it's either heaven or hell. And right now, it's heaven. It's absolutely perfect. And the Rich Dad Show is about the good news and bad news about money. And the reason we played the oldie but the goodies from the Everly Brothers, Dream, 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 is because so many people today are dreaming of retirement. I'm of the baby boom generation, and they're all getting ready to retire. 10,000 baby boomers in the U.S. alone retire, but all over the world, baby boomers are retiring. And they're all dreaming of retirement. But our guest today has some very interesting news. His name is Brian Reynolds. He's probably I think for this time period, the most important guest we've ever had on the Rich Dad Radio Show. So please pay attention. Even though you're not planning on retiring, it's going to affect all of us because what Brian is going to talk about may lead to, in the coming future, one of the biggest stock market crashes in the history of the world. And for those who have followed me, in 2002, I wrote Rich Dad's Prophecy. It was about the defined contribution pension plan, or what's called the 401k in America, RRSP in Canada, superannuation in Australia. And they're all hooked up to the stock market. So all of you out there right now who are hoping and praying and dreaming of retiring, or you've already retired, this is your program for you. So our guest today is Brian Reynolds, and I was cruising through YouTube, and he comes on, and what he said just, should I say, put the pieces of the puzzle together. Since 1983, I read a book called The Grunch of Giants by Dr. R. Buckminster Fuller, and I went to first see him in 1967 at Expo 67, the World's Fair in the Future, and Fuller was a futurist. So he built the U.S. Pavilion at the World's Fair in Montreal, Canada. And ever since then, I've been kind of wondering, what is this thing called grunge? Fuller wrote about grunge. It was called, grunge stands for Gross Universal Cash Heist, his book that came out in 83. So since 83, I've been putting pieces of the puzzle together. How are we ripped off in the world? And so Brian Reynolds, in that one YouTube video, put about 20 pieces of the puzzle together that I've been assembling for years and years and years. So, ladies and gentlemen, listen up. This is one of the most important Rich Dad programs you can listen to, because right now, if you're dreaming of a better future, whether old, young, or retired, this is your program. Because what Brian is going to explain to you is something that has taken me many years to track down. It's called the shadow banking system. And the average person has no idea what the shadow banking system is. So if you stick through this program, Brian's agreed to stay with us 3 times, you will learn more about shadow banking. You'll be one out of probably 10 million people in the world who know what this thing called the shadow banking system is. And again, I want to thank Brian for agreeing to be on this program. He's a investment strategy for the biggest corporations in the world. So we're very fortunate to have him come and talk to us little guys out here. So Brian, welcome to the program.
Thank you. It's good to be here.
Yeah, thank you. Could you give us a little experience, your background and all this? I mean, I heard it on YouTube, but you've really come from a very solid background to be an investment strategist.
Sure. So I started 35 years ago in this business, in 1984, and I worked at a firm on the buy side managing money for pensions. And I have some mentors that go back to the 1920s, 30s, and 40s. They taught me this investment business the old-fashioned way, to follow the money. And they rotated me through managing money market funds, bond funds, and equity funds. And that gave me a terrific perspective to follow the money, because the money comes in one area of the investment universe, say money markets, and it ends up being transformed through various credit structures, and it results in time over higher stock prices. But then when we get into a credit crisis, it leads to a disaster in stock prices.
So I wasn't too far off when I wrote Prophecy that we're cruising for one of the biggest stock market crashes. in history, but it's not the stock market. It's really like what you're saying is a credit market that's going to crash.
Right, and this has actually happened twice before. In the 90s, we had this debt-fueled stock market that went ripping higher year after year and sucked a lot of people in. And then when the credit market turned around and collapsed, it took stock prices down with it. And then we did it all over again in the next cycle. We started putting money into things like subprime mortgages, which helped fuel that stock market boom, sucked a lot of people in. And then when the credit market collapsed around that subprime structured finance industry, it took the whole stock market down and led to a lot of major bankruptcies, like Lehman Brothers. And then after that collapse, we started doing it again 10 years ago. So we've been doing this now for more than 10 years. Probably going to go on for another 3 to 5 years, but we're doing the same things that we did that led to those stock market collapses.
Right. So, Brian, would you say the big mistake the average person does is they watch the stock market, but they're not watching the shadow banking market? Is that correct? Would you say that's true?
I would say that's correct for the average person, but I'd say it's also correct for the average professional equity investor, because most people in the bond market don't talk to the people in the stock market and vice versa. And I think what I do is kind of bring those worlds together. And I think the more people can understand about credit, the better the decisions they can make for themselves.
Right. And so all of you listening out here, please, if you have a chance, go to YouTube. It's Brian Reynolds. And please watch this video. Like I said, I've watched it 15 to 20 times because I'm a slow learner. And every time I listen to it and watch it, I pick up some little nuance I didn't know before. And I'm pretty good at this stuff. And Brian makes it simple. But the problem with the shadow banking market, it's shadow. You cannot see it. And I was reading Daniel DiMartino Booth's book, Fed Up. She was an insider at the Fed. She says those economists, those 1,000 economists at the Fed, have no idea what the shadow banking market is either. So this is a very, very important program, especially for those who are dreaming of retirement or counting on the stock market for your retirement. If you're 22 years old and you have a well-diversified portfolio in the stock market, please listen to this program. Like I said, this could be the most important program you listen to at this time, because back in 2005, 6, and 7, I was warning everybody to get out of the real estate market. And I'm a real estate guy. I was saying this real estate market is going to come down. And because I listened to Brian's YouTube program, it's about an hour, I think, I understand it had nothing to do with real estate. It had to do with the subprime credit market. Would you agree with that, Brian?
Yes, and it's funny what a small world this is. Danielle's a friend of mine, and I really admire her thought process. So I think you're on the right track with this.
Yeah. So would you explain as simple as you can, because like I said, you are an institutional guy, and most of our guys are the little guys. We're out there trying to eke out a living, buying a couple of deals here and there and there. And some people invest in the stock market. But could you do your best to explain this thing called shadow banking? Danielle does a great job of it in her book, Fed Up. But when I saw your YouTube video, it put in more pieces here. So could you do your best to explain to the layperson like me, what is a shadow banking system?
Well, the technical definition is it's non-traditional banking, which doesn't tell you anything. So I like to phrase what banking is. Banking is a regulated bank, registered with the FDIC, that takes in deposits and makes loans. Anything else done by anybody else is shadow banking. In other words, it's outside of the banking system. And so, we propped up WorldCom and Enron with these crazy financial structures that nobody had heard of until they blew up. Then we did it again with these crazy structures for subprime that most people hadn't heard of until they blew up. And what it does, it takes traditional credit, traditional lending, and it transforms it into something that it is not. In other words, you can take a long-dated financial asset or just asset like fiber optics for WorldCom, and a shadow banker will take that and transform it into something that looks like a traditional bond with a shorter maturity and a very high credit rating. It looks super safe, but it's really backed by assets that are very volatile.
Right.
And when these things unwind and people want to sell them, there's no market for them, and so their price collapses, and that shuts off the flow of money to these companies that were trying to boost their stock prices.
So once again, you talk about here that it's like Danielle DiMartino Booth says it best. It wasn't the derivatives from subprime. That was just a virus. It was a shadow banking system that injected the virus called credit default swaps and all that into the system, and that blew up. And right now we're doing the same thing again, and this time what's going to blow up, what's causing it, is the pension market for public employees. So this next blow up is going to be the biggest ever. That was my prediction when I wrote Rich Dad's Prophecy in 2002. And you're putting in the pieces I didn't have. So if you could continue on and fill me in too.
So it all starts with our pension system. Our pensions, and we're talking about public pensions here, like the big California pensions, the big New York pensions. Most every state has a pension system. They've now become the dominant global investor. They're the biggest, collectively, the biggest impact on financial markets. They are 5 to 6 times the size of the Federal Reserve. And yet because they meet, in state capitals, the media doesn't really cover them. And each one looks at its own, portfolio. But they're all, they have the same group of consultants, so they all think alike. And most of them need to make 7.5%. So they're the biggest investor in the world, and they need to make 7.5%, which is crazy. That comes from years of underfunding our pensions, coupled with those losses and those other financial disasters in 1990 and in 2008. So the biggest group of investors has to invest as aggressively as ever in order to hit their 7.5% bogey.
Right, and what you're saying
so
here
that's
is...
the first step.
Yeah, let me step in. So for the average person is when the Fed started QE, started printing money, and then ZIRP, which is zero interest rate policy, that made the public pension problem bigger because they couldn't get 7.5%. And they had to turn to the shadow banking system in hopes of making up that 5 or 6% loss. Is that what you're saying?
That's part of it. But even if the Fed hadn't done quantitative easing and brought interest rates down so low, that 7.5 is far above where normal interest rates would have been, even if the Fed did nothing. In other words, starting around 1980, yields started coming down. This has been a 35, 40-year trend of interest rates coming down, and pensions did not bring their assumptions down with yields. They just put their head in the sand and said, it'll come back up. And yields didn't come back up. And that means they have to raise taxes more and invest that tax money more aggressively than ever to meet their outdated 7.5% assumptions.
And that's where we sit. And
pensions are
good. And that's where we sit today. And it's going to affect all markets, not only the bond market, credit market, stock market, and retirement market. And real estate market. It's the big pumpkin in the sky ready to blow up. Is that correct?
Well, it's not ready to blow up yet, I don't think. I think it's going to get more intense. But there's 2 more links in this daisy chain. So the first link is these pensions that are giant, bringing in money and need to make 7.5%. They can't make 7.5% in this environment through normal investing, so they hire these levered credit funds. The most famous of them was Long-Term Capital Management, which blew up in 1998. And these funds take incredible amounts of risks. They put on leverage. They put leverage on top of leverage. They package leverage into strange structures to try and meet their 7.5% goal. In the last 6 years, we've launched 6,000 of these funds. That's a staggering number. 6,000 new credit funds, all trying to reach for yields that are way above the market.
Wow. Hey, we're going to take a break, but I want to leave it right at that. I want everybody to listen to this program. All of our programs are important. All of our guests are important. But Brian Reynolds is the man of this time. Just like I said, in 2005, 6, and 7, I was warning people to get out of real estate. Now Brian is sitting here sounding alarm on what's next. And I think this is the most important Rich Dad radio program you can listen to. So we come back, we're going more with Brian, but I want him to explain further what is the difference between the shadow banking system and mom and pop banking on the street. We'll be right back. Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And of course, that's the oldie but the goodies from the Everly Brothers, Dream, Dream, Dream. And this program is especially important for all of you who are dreaming of retirement. I don't care if you're old, young, or already retired. This program is possibly the most important Rich Dad radio program you can listen to at this time in history. As I said, 2005, 6, and 7, I was warning everybody, and I'm a real estate guy, was to get out of the real estate market. And today's program, you better listen to our guest, Brian Reynolds, who, to me, what he said on YouTube just blew me away, because he's explaining something most of us have no idea exists. It's called shadow banking. It's not Bank of America or Wells Fargo or First Federal. This is the shadow. It's shadow because you can't see it. So once again, you can listen to the Rich Dad Radio program anytime, anywhere on iTunes or Android, and all of our programs are archived at richdadradio.com. We archive them because repetition is how you learn. And I've watched and listened to Brian's YouTube video at least 15 to 20 times now. Every time I listen to it, I pick up something new. So this program is especially important for you, but also friends, family, and business associates. Listen to this program, discuss it, and you'll see something that less than 1 in probably 10 million people know about is this thing called the shadow banking system. And every country in the world has their shadow banks. But the trouble is, I would say less than 10, maybe 100 million people really know what the shadow banking system is. So, Brian, you were talking about those 3 points. Can you just quickly review and then go on? I think we had time to get to the third point.
Sure. So the first point is our pensions, the California pensions, the New York pensions, all these big state pensions, are the biggest investor in the world, and they need to make 7.5% because of past underfunding. You can't get 7.5% through normal investing, so they hire leveraged credit funds that mimic long-term capital management from the 1990s. These funds put leverage on top of leverage to try and make their 7.5% returns. And the third link in this daisy chain is that they lend money to companies. They take this money from the pensions and they buy bonds from companies. Modern CEOs are incented to get their stock price up because of stock options. So they take this virtually unlimited amount of money that's coming from the credit funds, originating from the pensions, and the CEOs use it to buy their stock back. That's what's driven this whole stock market for the last 10 years. That's what drove the last bull market.
And so that's why you're saying, people like me hate the stock market because it doesn't make any sense. I mean, the fundamentals don't work anymore.
Well, it doesn't make sense because the credit market, which is investment grade and junk bonds, companies going to these credit funds to borrow money, the credit market is outpacing the economy. Since this credit cycle began in 2009, the U.S. credit market has grown by 85% cumulatively, while nominal GDP is only up 38%. So this is why the stock market has become divorced from the economy. It's all financial engineering, and these buybacks are what are driving stock prices higher. Investors as a whole have done nothing for the last 10 years. Individuals have put money into ETFs, but large institutions have taken money out of the stock market. So the net for investors is zero. It's all due to artificially levered buybacks, which people, I think, need to understand that. That's the biggest decision you can make, is why are you in the stock market? I believe it's going up for artificial reasons. I believe it's probably going to go up for a while longer. But when these artificial conditions end, you usually get a collapse in the credit market, which leads to a sharp down move in stocks.
But that was the whole point. Again, it wasn't real estate. It was a credit market that collapsed, and the next market will be the stock market and collapse. So all these young guys in their 401ks or RRSPs and superannuations, they're the next guys who will be caught when the credit market or the shadow banking market, like you guys talk about, when the shadow banking system starts to exit, everything collapses underneath of it?
Yes, exactly. And it happened before in 2000 when WorldCom and Enron collapsed. It happened in 2008 when Lehman Brothers collapsed. And the seeds of those collapses were planted a year before when the credit market started to melt down,
Right.
which is why I pay so much attention to the credit market.
So let me, there's something, you talk about the daisy chain, and I listened to that YouTube video so many times to pick it up. So let's take it, because I'm a very slow learner. That's why I need 15 to 20 times. So it starts off with a pension. So a pensioner puts some money in, and then that money is levered. So you make a contribution like CalPERS, which is the biggest pension in America. They put some money in, and then what happens with that money? How's that levered up?
Well, there's different ways to do it. The technical terms are liquidity transformation and maturity transformation, which sounds like gobbledygook. But what it does, it takes a low-rated asset and it transforms it into a highly rated asset that people want to own because they think it's safe. They slice it up into risky and less risky slices, kind of like how you can buy pizza as a whole pie or pizza by the slice. You pay more per slice if you buy it by the slice. And so that's what shadow banking does. It slices these assets up so that people will pay collectively more than they're worth.
But you also said something.
Which is great.
What LTCM did, was they take this little slice and they add leverage to it. Is that what you're saying?
There's different ways to do that, but basically, yes, you can slice assets any way you'd like. And what the shadow bankers do is they slice them in ways that their customers, these credit funds, will pay the most money for. And that's great while the credit market is liquid, while money's coming into it from the pension system. But because people are paying above the fair value of these assets, if enough people want to get out at the same time, there's not enough money to pay them off. That's what leads to these collapses, and that's what happened in late 2007, which led to the Lehman disaster in 2008. That was a year in the making almost.
So that was the real estate market, but as Daniel DiMartino Booth says, it wasn't real estate. It was the shadow banking system chopping up these credit default swaps, CDOs, collateralized debt obligations, putting them in tranches, and then levering them up. And when that failed, the credit fell out, and the real estate market collapsed. Is that pretty much it?
I actually have an easier way to phrase all of that in one sentence. I say it's not the quality of the bond; it's the quality of the bond holders. Because when they realize they're not going to get their money back, they start to panic, and that lowers the prices of their bonds even more.
So they exit.
They exit. And because the credit market is not a liquid market, the price drops get faster and steeper into a snowball.
Yep.
And that stops the money for buybacks, and companies can't buy their stock back anymore. And since people don't like stocks in general, the stock market collapses along with the credit market.
So credit market is not the same as stock market. Is that correct?
They're kissing cousins. Companies get their funding through the debt market. They go out and issue bonds, and there's a willing number of buyers because of these pensions currently putting money into the credit market, and they take that money and they use it to buy back their stock.
Okay, so this is the daisy chain thing you talked about. Let's step back. There's two things that you have on your YouTube video. One was the bankruptcy of Detroit and how that put fear through all of these public, like CalPERS or New Jersey pensions, public employee. So Detroit set that off, and that brought so the unions went out and they forced state governments to increase taxes. So all these new taxes came into the pension market, and all these new pensions then went to the corporate debt market. And then these CEOs, rather than taking this corporate debt and growing their businesses, they bought back their stocks, which is why the stock prices are so high today. Could you elaborate on that?
Yes. Sure. Well, the root cause of that was that most people's pensions most public pensions are guaranteed by the state. Some of the state constitutions actually put that in their constitution. Until Detroit went bankrupt, and the judge says you filed in U.S. bankruptcy court, which trumps state law, so the pensioners in Detroit had to take a hit on the unfunded liability. That sent shockwaves through the public labor union movement. And so they went to every major state and convinced them these liabilities are so big they need to make 7.5%. They made them, or they convinced them to raise taxes. Many of these tax increases are going to go on through 2023. They're now growing at a rate bigger than the federal tax cut that was granted in 2017. That was $1 trillion tax cut over 10 years. That's about $100 billion a year. Right now, new state and local taxes going into the pension system are growing at more than $120 billion a year. So fiscal policy is now now negative.
So the teachers, firefighters, and police officers, the state governments raised the taxes, but that negated the Trump tax cut. These tax dollars plus regular money plus leverage went to the corporate guys. They bought corporate bonds, and the CEOs, rather than using this money, this credit money, to build their businesses, they bought back their stocks. Is that correct?
Yes, it is. And because these tax increases are now getting larger than the federal tax cut, they help to keep the economy slow, which means people don't really want to invest in stocks, but it results in a bigger credit boom, which results in more artificially increased stock prices.
Wow. So, once again, ladies and gentlemen, it's Robert Kiyosaki, the Rich Dad Radio Show. We're talking to Brian Reynolds, and he is an investment strategist for the biggest institutions going, so there's no sense contacting because he won't contact you. We had a hard time contacting him. You know, I saw him on YouTube, and thank God he did that, and thank God he's on the Rich Dad Radio Show, because I've been chasing down and said, how does this shadow banking system work? So Brian is putting several pieces of the puzzle together. And what he's talking about, because like I said, in 2002, I wrote a book called Rich Dad's Prophecy, and I said the biggest stock market collapse is still coming. And it's still coming. So that's why this program is very important. As I said, in 2004, 5, 6, and 7, I warned everybody to get out of real estate. For those of you who are in the stock market, I don't care if it's 401ks or RRSPs or public pensions, this is your program. One of the most important programs you can listen to and share with your friends and family. We'll be right back. Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And again, those are the Everly Brothers, the oldies but goodies. Is for all of you out there dreaming of retirement someday, whether young, old, or already retired. This is possibly the most important Rich Dad Radio Show you can listen to. As I said, I was warning people about real estate back in 2004, 5, 6, and 7. You should have listened then. And today we're talking about something else. It's the stock market, but we're not really talking about the stock market. The reason this program is so important is because our guest today is Brian Reynolds, and he's talking about the shadow banking system, a.k.a. the credit market, and the leverage in the credit market. The credit market is now the biggest market in the world, but also the biggest investor in the world are pensions. And these pensions is what Brian is explaining. So once again, you can listen to the Rich Dad Radio program anytime, anywhere on iTunes or Android. And you can listen to this program again because we archive it at richdadradio.com. Listen to this program again, as I did with Brian's YouTube video 15 to 20 times. And then share this podcast with friends, family, and business associates and discuss, and you'll find your intelligence jumping up. And we've asked Brian to stay on. We're gonna ask Robert simply because he's such an important guest at this time. So Brian, could you let the audience, our listeners, know right now what you think is most pertinent?
Well, I think the most pertinent thing to know is that this money coming into the pension system is pushing asset prices higher, whether it's the stock market or commercial real estate. It's finding its way to push prices up. I think it's going to continue for a while. I think it's probably going to intensify because there's going to be more money coming into our pension system. And so if you're in the stock market or any other asset class, you need to know that most of this is artificial, and that will help you make an informed decision, because when this goes into reverse and people start to clamor to get their money out of the credit market, it usually takes other asset classes like stocks and real estate down.
Right, and it's not people, it's pensions want to get out, right?
It's the people in the pensions when they want their money.
Right.
Sometimes it's in the safest investments. Sometimes it's in a cash fund, because a cash fund, if it reaches for yield and people think it's worth $1, and it's in illiquid stuff that's trying to push their yield up and people want to take money out of the cash fund, that usually is what starts these crises.
Right.
When people take money out of the safe stuff. Then the risky stuff follows on later.
So talk about risky is what happened is, so Detroit went bankrupt. All the states started raising taxes, which are taxes are now offset Trump's tax cut. These taxes are going in. They're buying corporate debt. And many corporations have gone from AAA to triple B or pre-junk. In other words, like some of the companies that have very horrible credit were one-time AAA. Some companies like, General Electric had great credit. General Motors had great credit. AT&T had great credit. Ford has great credit. But
AIG.
now, what's that?
AIG was AAA at one time.
Yeah. And because of all this money going into the credit market, which corporations like CEOs like Jack Welch of GE borrowed to push their stock price up. And everybody's happy right now. But let me ask this question. This is a very important question. Why would a CEO take all of this money coming in through their corporate debt? These pensions are giving General Electric all of this money. Why don't they grow the company? Why are they buying back their stock?
Well, there's two reasons. One is that their stock options incent them to push up the stock price. And the second is that if they don't do that, and they say they're not going to borrow money to try and push up their stock price, these corporate raiders will come in and take the company apart and sell it piece by piece to the highest bidder, funded by the credit market.
So it's
the
almost
CEO can either go along with it, or somebody else will do it for him or her.
So it's almost a defensive move to make your company less attractive.
This started in the 1980s with the corporate raiders. Companies' balance sheets, their credit ratings, as you mentioned, were much higher back then, and the raiders were taking over the companies, and funding them with junk bonds. So CEOs said, hey, let's lever up and get our stock price up instead of letting the raiders do it for us.
And is there one more reason is that then the corporate executives can parachute out with stocks, which are capital gains, but it leaves shareholders and employees in a zombie company? Is that what's going on also?
Yeah, that's why we had two collapses in 2000 and 2008. We're doing the same thing all over again, just with different financial structures and with more money.
And as you said, pensions, public pensions, are now the biggest investor in the market today.
Yes.
So before we end, Brian, I want to thank you for making it simple enough for a person like me to understand shadow banking and the credit market versus the stock market. But what advice would you have for everybody right now, young, old, or retired? What would you say to them?
Look over your asset allocation, whether how much stock money you have, how much money market money you have, and realize that the risky stuff is being driven artificially. And so you want to make a good decision for yourself how you weight those things, stocks, bonds, and cash, knowing that this is being driven by an artificial daisy chain.
And the last thing, I thought was very important what you said is, for the average person, who are just dreaming of retirement, a lot of times they get lulled into complacency that what they're in is a safe investment. And you said some things on your YouTube video that the next one to go is commercial real estate. Is that your prediction?
That's one of the areas that this pension money is being put to work in. And we'll take commercial real estate leases and we'll slice them up so that they look like highly rated securities when in fact they're backed by volatile commercial real estate.
Jeez. Well, Brian, I don't know what else to say, but thank you.
Thank you for having me on.
Yeah, I mean, if I could have you on again, I'd appreciate it because, like I said, I just can't believe this is going on because I'm a pretty simple person. If it doesn't make sense, don't do it. But what you're saying about all these public pensions for teachers, firefighters, and police officers, it really makes no sense. And so it puts the whole world in a precarious position.
I think it's going to go on for a while longer, so I'd be glad to come back on in the future.
Right, right. And you said there's going to be one big blow-off before the blow-off. one big
Yes.
bubble before the blow.
Usually the last 2 years of it. Usually the last 2 years of it are some of the best years in the stock market.
That's good news.
And then it turns around.
Okay. Hey, Brian,
Well, it is what it is.
Right. I really, really want to thank you for sharing your years of experience and wisdom for the general public. I mean, you're the right man at the right time with the right message. Thank you again.
Thank you.
Thank you.
Have a great day.
Same to you. And for all of you listening to the Rich Dad radio program, I thank you for listening, and a big thank you to Brian Reynolds.